They told you it was a one-time emergency, a freak accident, a crisis that would never be allowed to happen again. They called it too big to fail, as if it were a law of physics, as if certain banks were so important that gravity itself would stop working if they collapsed. But too big to fail isn't a safety net. It's a threat dressed up as stability. It's the financial system holding the public hostage and calling it protection. And here's the truth nobody wants to say out loud. It didn't die in 2008. It didn't weaken. It didn't even really change. It evolved. The words became more careful. The paperwork became thicker. The speeches became smoother. But the underlying deal stayed exactly the same. When the next panic hits, the public will be told the rescue is for everyone. But the benefits will flow upward, as always, because this isn't just a policy choice. It's the architecture of modern finance. Money, power, and history collide, and nothing is ever as simple as it looks. Banks don't just store money, they manufacture trust. And when trust breaks, everything that depends on it trembles. Wages, businesses, pensions, trade, politics, even social order. That's why the lie keeps returning. Not because leaders fail to learn the lesson, but because the system is designed so the lesson can never truly be learned. To understand why too big to fail is inevitable, it helps to start with the oldest problem banking has ever had. It's not greed. It's not corruption. Those are human features, and humans appear everywhere. The oldest problem is structural. Banks promise instant access to money while locking that money into long-term bets. Deposits are short-term. Loans are long-term. Even the safest-looking balance sheet is built on that mismatch. It works as long as people believe it works. It works as long as the crowd stays calm. It works until fear enters the room. Because the moment enough people demand their money at once, even a healthy bank can die in a day. Not because it is insolvent, but because it is illiquid. It doesn't have the cash in the vault. It has promises on paper, and paper doesn't stop the stampede. This is not a modern invention. In the 19th century and early 20th century, bank runs were common. People didn't need spreadsheets to trigger collapse. They needed a rumor, a whisper in a marketplace, a headline. A neighbor said, "I heard the bank is in trouble." Panic spreads faster than facts. And once a run starts, it becomes self-fulfilling. The bank fails because people believe it might fail. Governments learned very early that a bank failure isn't just a bank failure, it's contagious. Banks are not isolated companies. They are a web of promises linking depositors, borrowers, businesses, payment systems, and one another. One institution falls, and suddenly everyone questions the next one. Credit tightens, merchants hesitate, payrolls stall. The economy becomes a machine starved of lubrication. So states built tools to contain panic. Central banks became lenders of last resort. Deposit insurance was invented to stop ordinary people from running to the door. Regulations were written to force banks to hold more reserves, more capital, more buffers against disaster. These tools were sold as protection for the public, and sometimes they were. But they also created something else, a quiet guarantee, a promise whispered into the structure of the financial system, a signal to the largest institutions that if they grew big enough, interconnected enough, essential enough, they would not be allowed to die. This is where the lie begins. The phrase, "too big to fail," sounds like an objective description, but it's really a political conclusion. It means the costs of failure have been made so terrifying that rescue becomes the easiest choice in a moment of panic. It means private institutions have become so entangled with public stability that the boundary between them blurs. To see how this works, imagine a small bank on the edge of town. If it fails, it's a tragedy for its customers. It's disruptive, it's painful, but it doesn't stop the national economy. People suffer, but the system survives. Now imagine a giant institution sitting at the center of finance, handling payments, clearing transactions, providing credit, trading collateral, connecting markets across borders. Its failure doesn't just harm customers. It threatens the plumbing of the entire economy. That is what systemic means. Not morally important, mechanically dangerous. And here's the key. That danger is not purely natural. It is built. The system is allowed to become so interconnected and concentrated that failure becomes unthinkable. Then the unthinkability becomes a weapon. In a crisis, the biggest institutions don't say, "Save our shareholders." They say something smarter. They say, "If we go down, your economy goes down." They say, "If we fall, wages stop, businesses collapse, and voters will panic." And when fear is high, that argument works. Not because it is always fully true, but because it is true enough that leaders cannot gamble against it. So, systemic risk becomes a shield, a magic phrase that transforms private losses into public responsibility. It turns the threat of collapse into leverage. It makes rescue feel like the only adult choice, and letting failure happen feel like reckless sabotage. Once that shield exists, every incentive changes. Risk stops being punished and starts being rewarded. The upside belongs to the institution, the executives, the shareholders. The downside is softened by the expectation of rescue. This is the moral hazard at the heart of modern banking, and it isn't a theory. It's a business model. Then came 2008, the moment the public saw the machine. For years before the crisis, leverage grew, complexity multiplied. Risk was disguised as innovation. Loans were bundled, sliced, and repackaged into products so intricate that even experts argued over what they truly contained. It looked sophisticated. It was often camouflage. The system was building a tower of promises stacked on top of other promises, all resting on the belief that housing prices would not fall everywhere at once, that liquidity would always be available, that markets would always function. When the tower began to crack, panic spread through the same web that had been celebrated as efficient. And authorities faced the nightmare scenario, a collapse so fast and wide that payments could freeze, credit could vanish, trade could stall, and millions could lose jobs within weeks. When the bloodstream of finance clots, the body does not politely wait for theoretical solutions. So rescues came, emergency lending, guarantees, bailouts, backstops, programs with acronyms designed to sound technical and neutral. The public was told a story over and over. This isn't for the banks, it's for the economy. This is to protect ordinary people. This is to prevent collapse. But the reality was stark. Losses were socialized, gains remained private, institutions survived, many executives moved on. The financial core was preserved. The public absorbed the cost, directly through taxpayer money in some cases, indirectly through weakened purchasing power, suppressed returns on savings, and a long recovery that often inflated assets faster than wages. The bailout wasn't just a response, it was a precedent. It declared that there are institutions above failure. And once a class of untouchable firms exists, it does not vanish. It gets formalized. It gets embedded into policy, markets, and expectations. After 2008, politicians promised reform. They promised that the era of too big to fail was over. They promised higher capital requirements, stricter oversight, stress tests, orderly liquidation plans, living wills that would supposedly allow giants to fail without taking everything with them. The paperwork was impressive. The slogans were soothing. Some of it mattered at the margins, but the deepest incentives survived. The system did not become simpler. It became more complicated. And complexity is not just technical detail. Complexity is camouflage. Because the real question was never, do we have more rules? The real question was, can the biggest institutions truly be allowed to fail in a real panic without forcing leaders to choose rescue anyway? The honest answer remained painfully close to no. The interconnectedness didn't disappear. Banks remained bound together through short-term funding markets. Collateral remained the glue of modern finance, and collateral depends on confidence. Derivatives still linked balance sheets across borders, and markets continued to behave as if rescue was available in the background, because in the moments that matter most, rescue has repeatedly arrived. It's like installing more fire alarms while storing more fuel in the basement. The alarms might work, the plans might be printed, but the building's design still makes a blaze catastrophic. And over time, too big to fail became politically toxic language. It sounded like what it was, privilege. So the system changed the words. It stopped saying too big. Oh, it started saying systemically important. It started saying critical infrastructure. It started saying market stability. The guarantee stayed. The branding improved. And the guarantee spread beyond banks. Modern finance is not just banks holding deposits and making loans. It's the plumbing. Clearinghouses, payment networks, custodians, market makers, and the shadow banking world that does bank-like things without always being regulated like a bank. It's the short-term funding markets that keep large institutions alive day by day. It's the repo market where collateral circulates like oxygen. It's money market funds and other structures that promise safety but rely on smooth markets to deliver it. This is why too big to fail can never be ended by speeches. Because the concept is no longer confined to one institution or even one sector. It is embedded in the system's dependence on constant liquidity and constant confidence. In the modern era, central banks don't just influence markets. In crisis, they become market makers of last resort. They provide liquidity when private actors step back. They accept collateral when no one else will. They stabilize prices when fear threatens to turn selling into a stampede. They step in to ensure that the system continues to breathe. And this creates a paradox. The public is told the system is safer because guardians stand ready. But the presence of guardians also changes behavior. It encourages the growth of structures that assume rescue. The backstop becomes part of the business plan, even if no one admits it out loud. So what happens when confidence cracks? History answers that with brutal consistency. The moment trust wavers, the abstract becomes physical. It becomes a line outside a bank. It becomes frozen withdrawals. It makes businesses unable to roll over short-term loans. There will be layoffs and closures. It becomes the sound of the economy grinding. When crises hit, the well-positioned move first. Money is moved, assets are sold or hedged. The institutions with access to liquidity survive the squeeze. Those without access get crushed. This is what a panic does. It reveals who is connected to the lifeboats. And because leaders fear the visible suffering of a full collapse, rescue returns, not always as a simple bailout check, but through quieter channels that achieve the same outcome, protecting the financial core first. This is the part rarely discussed honestly. Rescue has costs, and the costs are often hidden in mechanisms that on a T look like taxes but behave like transfers. When central banks flood the system with liquidity, they stabilize asset markets. When rates are held low for long periods, asset prices inflate. When emergency support protects collateral values, those who hold collateral benefit first. The system claims these measures protect everyone, because if finance collapses, the economy collapses. But the transmission mechanism is not equal. Who owns the assets that surge when liquidity rises? Who holds the portfolios that recover first? Who benefits when the system's priority is stabilizing markets? The answer is not mysterious. It is those closest to wealth and leverage. Meanwhile, wages often lag behind the new reality. Rent climbs, living costs rise, savings earn little. The public experiences the rescue not as a gift, but as a slow erosion, a sense that the economy is healing on paper while becoming harder to live inside. This is why too big to fail cannot be separated from inequality. The promise of rescue preserves the financial core, and the financial core is not owned evenly. The system doesn't break evenly, and it doesn't get repaired evenly either. The defenders of rescue will say it is necessary. They will say the alternative is worse. And sometimes, in the narrowest sense, they are right. Allowing the entire payment system to freeze would be catastrophic. Letting credit vanish overnight would destroy businesses that have nothing to do with Wall Street. The public would suffer in the most visible, immediate way. But there is a deeper question beneath that argument. Why is the system built so that rescue feels like the only option? Why has concentration been allowed to grow until certain institutions become essential infrastructure? Why is the public repeatedly placed in a position where it must pay to prevent collapse? Because too big to fail is not just an event. It is a structure. It is a trap set by incentives. Politicians don't survive panic. They survive stability. In the moment of crisis, the decision is predictable, not because leaders are villains, and not even because they're always corrupt. It's predictable because the system arranges the incentives so that rescue is the least politically catastrophic option. When every path is terrible, the path that postpones disaster is chosen. And then, once rescue happens, the lesson to the market is written in fire. The next time, expectations adjust. The cost of funding the biggest institutions stays lower because they are assumed safer. Their growth becomes easier. Their influence expands. The web tightens. The shield thickens. So the lie returns because the system rewards those who believe in it. It rewards institutions that push up against the boundary of risk because the boundary has been blurred by precedent. It rewards complexity because complexity hides the true shape of exposure. It rewards size because size becomes leverage in a crisis. The phrase, too big to fail, pretends to describe a natural reality. But it is really a confession. It confesses that failure has been removed from the top of the system. And when failure is removed from the top, it does not disappear. It moves downward, to savers who earn less while prices rise, to workers whose jobs vanish when credit contracts, to taxpayers who fund rescues directly or indirectly, to communities that absorb austerity and stagnation while asset markets rebound. This is the oldest rule of modern finance. When the system breaks, it doesn't break evenly. And when it is repaired, it is not repaired evenly. The next crisis will arrive the way they always do. Not when everyone expects it, but when everyone feels safest. When risk has been disguised as normal, when leverage has been justified as efficiency, when markets have been lulled by years of calm and the guardians have convinced everyone they can manage any storm. And when the moment comes, the words will sound familiar. This is for stability. This is for confidence. This is to protect the public. We had no choice. Listen carefully when that happens. Because behind the language will be the same mechanism, the same trade, the same bargain struck again. Protect the core and let the costs diffuse through the rest of society. Too big to fail is not an accident. It is not a mistake left over from 2008. It is a standing policy, activated by fear, justified by complexity, and maintained by incentives. It is the financial system's favorite myth, that it has tamed risk, that it has contained collapse, that certain institutions have outgrown failure. But history doesn't care about myths. It cares about structures, and structures repeat until they are rebuilt. Debt isn't just a burden, it's architecture. Banking isn't just a business, it's trust, engineered. And too big to fail isn't a warning, it's a promise. A promise that, in the moment of crisis, the public will be told the rescue is for everyone, while the benefits flow upward as always. Because the lie keeps returning for a simple reason. It works.